What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, the breakdown is how you manage being assigned a stock with a cash secured put. So if you're excited for today's video, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. And what I want to do here is kind of show you guys the other half of the wheel strategy, because with the wheel strategy, a lot of the videos have been talking about cash secured puts and not the other side, which is covered calls. And so the company that I'm focusing on that I got assigned shares on last week was Novo Nordisk, NVO. As you'll see, I have 100 shares of this company that I was assigned on Friday after market closed, because it closed below 68, or it closed below 69. It closed at, I don't even know where it was at. It closed like right here. So it closed at like 68.50, like on the dot 68.50, which is like amazing because my average cost was 68.49, and we'll break down that math in a little bit. But as you will see here with this company, I was assigned the shares at $69 for each one. The reason why you get assigned the shares is because the ticker symbol closed under the strike price that you set it at. I set it at 69. It closed at 68.51, which means as a result, I am forced to buy the shares. Now, again, I had cash put away for collateral on top of it, so the cash just moved over to buying the shares as a result. So now we have 100 shares of Novo Nordisk, and the question is, what do we do from here? Well, now that you have 100 shares of your company that you are okay with owning for a discount, which is what I basically got for, once you own the shares at 100 shares at a discount, you then can sell what's called covered calls. The idea behind that is, again, same thing. You're selling options to get a premium payout for it, but then you're also going to be telling the person who buys your contract, hey, I will sell my shares at this strike price. And so what we're going to do is we're going to break down the math from start to finish as to how it worked and how you open up this trade, and then talk about the math and the potential gains that we could have between now and July 25th, which is when the expiration date is for this company. So if you go to trade Novo Nordisk options here, again, you would go to sell an option, and instead of selling a cash secured put, which is what this would be right here, you would sell a covered call. And I went to July 25th and I picked the 72 strike price right here. Why did I pick that one? Because I was okay with giving away my shares at $72 for each one. That's a $300 profit in a month on my shares themselves. I got assigned at 69. I would then sell them at 72. I make a quick $300 just like that from the shares. I'm totally cool with it, and we're going to break down the math. And again, I paid, let's go back to the actual option I paid for. I got paid $188, I believe, for it. Let me take a look. Yep. I got paid $188 for this covered call. So we're going to break down the math here as to where we're looking at and my potential returns for the month with Novo Nordisk. So first thing we did, as you will know, is that we sold a cash secured put for $69 strike price, and we got paid $51 for it. So you paid $51 for this trade to even be opened. Now, what happened, obviously, as we know, is that we got assigned those shares at $69 because it closed below that on Friday last week. And now I have 100 shares at $69 each. And then what we did was we then sold a covered call. Now, why did I sell a covered call today? The reason that we sold the covered call today is that if you take a look back at Novo Nordisk, is that it is up in the green for today. And I sold it around I think it was around here before it kind of came back down a little bit again. And the reason why I'm selling a covered call on a green day is because the premiums are a little bit higher, so you get more return. So if I go to trade options here, you'll see that the option that I picked is actually up. It was up a lot more than that. I'm already up like $13, but it was up a lot more than that as the result here. And now it's losing value because it's starting to come back down again. So this basically just creates just a situation, like a ceiling of saying, hey, as long as it doesn't go to $72, I keep my shares and I keep the premium that comes with it. So let's take a look at the actual options that we have here. First option here. So we got paid $188 for this one. If Novo Nordisk goes to $72, we will get also $300 in share value profit because we got it 69, now it's at 72. And we also got paid $51 for the trade that we started with the wheel strategy here. In total, for the month, starting off with the sold options here till July, if it closes at 72, we would have made as a maximum profit, we are looking at $539. And with using $6,900 cash as collateral, that produces a potential return of 7.8% on this cash in a little over a month. And that is a very good return. A little over 7% in a little over a month is a very good return for the stock market. So that's kind of what we're doing here. Now, here's the nice thing about Novo Nordisk. If it doesn't get to $72 by July 25th, not only do I keep the shares, I also keep the $188 for the premium that I got paid to sell this option. So the idea behind selling a covered call here is you want to make sure you're picking companies you're okay with selling at a certain price. Okay? So if I want to sell at 72, I'm okay with taking the $300 gain on my shares. I'll sell it there. I get paid almost $200 for the option and another $50 or so from the cash secured put. And then what happens is that cash then becomes freed up in my account to then run again and to do it again. Now I do cash secured puts again. Then I do covered calls, cash secured puts, covered calls. That's why it's called the wheel strategy. So that's the idea behind it. They're being assigned those shares. We're waiting to see what happens. And again, right now the trade is already up. We are already sitting pretty up $16 already because it's starting to come back down again. And as we see that this is going to start to depreciate in value from theta decay, it's going to be interesting to see when do we close this trade out. So if this company has a huge red day in the next couple of days here, I might already close it out, take a lot of my profit off the table, because there's no need for it to sit there any longer. If I already juiced up a lot of the premium, took all of it out already, there's not really much left. So you got to kind of manage it also in that case as well. And then what people will say is they'll say, well, Fridge, what about if it goes above 72 and maybe it's got this momentum now? Now you don't want this to happen here. And I'll break down again an idea that you can do with options here, and it's called rolling the position. Basically, what rolling is going to do is that it would close the contract you have open right now and then open a brand new one. So say, for example, Novo Nordisk announces a new partnership with a different company and it gets a huge push up and we're going to have some big momentum play coming for the next couple weeks potentially. I will go to roll the position. And basically what would happen is, say I want to go, an extra week out and I want to jump the strike price up. Actually, we'll go maybe 2 weeks maybe. So now we're looking at, 2 weeks out after the 25th. And say I want to push it to, say, 74 strike price. So what this does is that it's going to close the current one that you have, open a new one. And this trade, for example, would give me $73 in extra cash here. It's fluctuating a lot right now. This trade will give me a extra credit, and also it gives me an extra $100 in the ceiling of the profitability because it goes from 73 now to 74. So the fact that you're going from 73 to 74 increases your share profit by $100 potentially, and you might also get a extra credit because the strike prices have a huge spread, right? You could also, if you really wanted to, again, you could do it for a debit. I could roll it to $80 and say, well, Fridge, why would you do that? You had to pay a debit of $60 here. But think about it. I'm pushing it from 73 to 80. That's an extra $700 in share appreciation. I would pay $80 for a potential of a $700 share price appreciation. Now, it's not guaranteed to happen. Again, rolling positions can be tough to manage at times, but they do work out pretty nicely. If you love the company, you're like, you know what? It's got momentum. It has earnings coming up here. Let me just roll it out higher just in case to make sure I can maximize that profit there. So that's kind of where we're at right now. Again, looking at a max potential of almost 7.8% on Novo Nordisk. Again, we are already sitting up on this trade itself, already up about $17. The shares are still profitable, which is great. So overall, I am still in profit with this company right now. So we're going to see what happens here. We're going to be managing the trades and going from there. So thank you guys so much for watching today's video. If you made this far in the video, feel free to like, as always, subscribe to the channel, and turn on those bell notifications for all future uploads. We do hope you're making money in the market as per usual, and I will see you guys in the next video.